Introduction. Do you worry about the future, or is of those who do not think much about tomorrow? There is no right way to live life. After all, it is not a cake recipe that everyone should follow. Living without thinking about the future can be a way, but what if there are people who depend on you? Or if you do not have any other income except your salary, what would you do if you were unable to work? Maybe it's a good idea to begin to understand how it works and what it is for a life insurance. And you know why more people are looking for an individual life insurance? Because they realize that it is the foundation for your financial security and your family. With it, if anything happens to you, your spouse will be able to pay off the house you bought together with a lot of work, so as to enjoy a quiet life when you get the best age. Life insurance can ensure that your dreams and the dreams of those you love are carried out, even if you are no longer present. Chapter 1. What is life insurance? Life insurance is a contract that you make with an insurance company to ensure financial protection for your family and people who depend on you in case you're absent. It is a safe which can also benefit you directly in the event of permanent disability or a serious illness. The contract of this type of insurance must have coverage for the risk of death which occurred due to natural or accidental causes. Also, in the case of survival coverage found in pension plans, compensation paid at once or in the form of income if the insured survives the period stipulated in the policy of life insurance. The central and mandatory coverage of life insurance against the risk of death may have additional guarantees provided for in the insurance people. It is possible because life insurance is part of personal insurance. It has several covers: death, disability by accident, permanent functional disability due to illness, permanent disability productive working by illness, severe daily diseases, regular temporary incapacity, unemployment and loss of income, etc. What benefits life insurance provides? When there is a lack of the person who is the provider of the breadwinner, usually the standard of living of their dependents tend to fall. Financial difficulties also occur if the vendor becomes a physically challenged person or becomes seriously ill or prevented from exercising his professional activity, etc. Ensure personal protection, providing financial protection in the event of these fatalities occur, is the primary goal of personal insurance, including life insurance. Thus, the life insurance is a social welfare instrument as it contributes to mitigating the adverse financial conditions that the insured or his recipients may face if any of the covered risks materialize. When buying a policy of life insurance, you choose the recipients and set the value of the insured amount, which is the maximum amount to be paid by the insurer in the event of an accident in the contract. Life insurance provides protection to families from different social strata, especially those that have little or no equity or financial reserve. For these, in particular, the lack of provider or your permanent disability is committed wholly or significantly and immediately to income and livelihoods dependent. This type of insurance helps to maintain the family's standard of living, the continued study of the children, keeps the house, and ensures the discharge of home financing, among other expenses, until the financial capacity is recovered. Another benefit of life insurance is that the amount paid by the insurer to recipient in the case of death of the insured does not enter the inventory or can be released quickly and without tax transmission causa mortis. Life insurance contracts have been used in an unconventional way in American law, whether as an instrument of tax avoidance by large corporations or even as a means of financial speculation. In this sense, there is the emergence of a kind of life insurance called corporate-owned life insurance, COLI, property of the corporation's life insurance. It is a life insurance modality by large US companies and which has been the subject of considerable criticism today. This type of life insurance is to the beneficiary company itself, which carries out life insurance that are insured all its employees. Such life insurance, when performed by banking institutions, are called bank-owned life insurance, BOLE, bank-owned life insurance. Other names for this unconventional life insurance mode are also found in the literature, such as dead present life insurance or even custodian insurance. The idea behind the realization of this life insurance mode is nothing more than a bold corporate strategy and morally repugnant to reduce the payment of income tax. Some estimates indicate that large US companies have saved billions of dollars a year in the payment of income tax through the use of this life insurance mode. Also, this type of life insurance is so advantageous for large companies that have influenced negatively in the allocation of resources in the US economy. That is, the resources that should be allocated for the increase of production activities of the companies are only being invested in insurance contracts of life of employees. Initially, the purpose companies hire life insurance on behalf of their employees, dead peasant life insurance policies, and in the need to create protection for the company against the risk of losing employees key employees, and highly train the company in the event of someone's untimely death. However, it can be said that this initial purpose has been completely distorted, especially from 1990, when some large companies began to perform life insurance on behalf of all employees and not just the so-called key employees. These companies were aimed only getting a significant tax advantage over the years because they took advantage of a loophole in the tax law that excluded the benefits of life insurance payment of income. From this tax form, they profited doubly with the reduction of the amount payable in respect of income and also with the death tax of their employees, because they were the beneficiaries of life insurance of their employees were insured. Before moving on this issue, it should be noted that the life insurance contract in the USA has a structure similar to life insurance practiced in many countries. In short, the life insurance contract can be defined as the legal transaction by which the insurer undertakes, in consideration for the receipt of the award, payable to the insured or to a third party certain amount in the form of capital or income when the verification of the planned event. Brazil also supports the so-called group insurance, in the person of the policyholder does not overlap with the insured. There is only one contract, although personal relations are independent, set up because as insurance on the lives of others. In the insurance case on the life of another, this figure that resembles the corporate-owned life insurance COLI in Brazil, it is necessary that the policyholder shows your interest in the execution of the contract. However, this interest is presumed to exist when it comes to spouse, parent, child, or tenderer's brother. Just for comparison, it is important to note that many countries, the value of life insurance are freely set by the proposer. Furthermore, it is also permitted the realization of life insurance on the other. However, in Brazil, the Brazilian legislation establishes that the applicant is required to declare, under penalty of falsehood, their interest in preserving the life of the insured. Also, the life insurance or personal accident insurance in case of death, the stated capital is not subject to the debts of the insured or are considered heritage for all purposes of the law. Finally, life insurance in case of death, it's awful to stipulate a waiting period during which the insurer isn't responsible for the occurrence of the accident. It is also important to mention other types of businesses that have emerged in the United States about life insurance contracts. After the 2008 financial crisis, US banks have found new ways to profit from life insurance contracts. They passed, for example, to invest in buying and selling of life insurance policies of elderly and sick people. Such policies are then sold to investment funds that become life insurance beneficiaries and speculate regarding the death of the insured. That is, the sooner the insured elderly or sick should die, the greater the profit of the investment fund, which happens to be the beneficiary of the insurance. If the insured dies, the fund may have a small financial return or even injury. This type of speculation with life insurance contracts is different from the so-called corporate-owned life insurance, COLI, in the sense that the elderly and sick did not mention banks used or have any working relationship with investment funds. It is just another form of speculation in life insurance contracts. For all the above, with no claim to exhaust this topic, it appears that the unusual practice of using the US life insurance contract have represented a successful attempt to tax avoidance and financial speculation. However, such practices should be abolished by the US Congress as they completely misrepresent the objectives of the life insurance contract, as are reprehensible from an ethical point of view. It is unacceptable that companies profit from the death of their employees and by stimulating speculation at the expense of realization of investment in productive sectors of the economy, misallocation of resources. Life insurance is not as popular as insurance cars, but can take your family or even yourself a grip on a dramatic moment. According to insurance experts, some myths still keep the Brazilian this type of product since it is difficult for most people planning for such a long-term deal with the possibility of their death or even measure the real benefits life insurance. Chapter 2. Life insurance is not just for death. Life insurance is not only for death, but is also to death. But nowadays, life insurance can offer many covers, many of which allow the recovery of funds by the holders still alive. The life insurance coverage for other commonly brings complicated events such as temporary disability, which leaves the insured time without working and therefore without generating income, and permanent disability. Insurance that provides coverage for serious diseases or terminal illnesses, for example, allow the rescue of a given amount if the insured passes through one of these situations. In this case, it can use the money as it sees fit to fund travel for treatment or provide features that let more comfortable. There is one story of an insured who was diagnosed with a terminal illness and decided, with the money that could redeem, to make a great party, gather all the friends he made during the life around the world. For some, event sent the tickets. During the party she explained her situation, but said her intention there was just celebrating life alongside those she loved, said the witness. Conversely, life insurance may also have coverage for survival. Life insurance. It does not have to be expensive. In the case of a life insurance, be costly or cheap may depend more on the need of the product and other factors. Learn to weigh before making a life insurance, including on price. You may need a vehicle to leave immediately accessible resources to your family after your death, and insurance are advantageous not come into inventory, or have young children who need to have all their education funded. Life insurance may be designed for different pocket sizes. Additionally, there are ways to circumvent the high costs. The case of an insured person to arrive at a more advanced age with a higher cost of life insurance set before the children who share the prize. As they would be the beneficiaries of the insured amount, the children agree that it would be an interesting way to invest in your future at a cost that was down to each. Life insurance. Your business may not be enough. Many people have the opportunity to make life insurance through the company where they work. It is one of the benefits that companies often offer employees. It's an error to think that this mutual insurance is enough. You need to check if it suits your needs. They may miss important coverages and their value may be little. The principle, however, is to keep in mind that if you are fired or decide to leave the job, you lose the life insurance together. And depending on your age and health condition, to make a new policy can be expensive compared to what it would be if the insurance had been done earlier. You can make a life insurance even if you have health problems or smoking. In such cases, you can do so safely. The difficulty is that you cannot get certain coverages, or some of them will be more expensive. Individual coverage may be denied in life insurance if the person has a serious illness or a combination of risk factors such as hypertension, obesity and prediabetes. Single people without dependents or may need life insurance. If you are single and have no children, yet can be a good idea to make a life insurance. First, because depending on your reserves, insurance against temporary disability or permanent can be critical. This coverage is sold separately but may also be obtained from a life insurance policy. Second, the veracity of this statement also depends on its future plans. If you do not intend to be a confirmed bachelor, if you want to get married and maybe have children, you should plan it now. One needs to think about where he wants to be in the future. A single could get good coverage at a good price, while he is still young and healthy, that perhaps did not get further if he decided to make the insurance after discovering a health problem. The young man who wants to have children in the future can even hire in life insurance a reserve for repurchased education in life, planning their study early. Insurance is customizable and can protect entrepreneurs. Quarry drew attention to the fact that even people who have good income and a great heritage make life insurance. That is, it may cover any spending on health or education, and being able to leave a great legacy for the family, these people are protected. Life insurance has the ease of not entering into inventory, for example, freeing up resources quickly for the family after the death of the insured. If the insured has much of its assets in real estate, life insurance can be attractive for the heirs to have money on hand to pay the tax on the transfer of inheritance, ITCMD. The angel investors, entrepreneurs and other people who risk part of their personal assets also make life insurance, just for taking the risk. Thus, at least the family is sheltered. Some more technical business partners, such as engineering or medicine companies, often make a policy to ensure that the company has resources to buy the part of the heirs in case of death of a partner. They do not want heirs other than the area to take the business. To put it simply, you should buy a life insurance if genuinely you care about someone and their financial resources are not enough to fill the financial gap left in the case of its death. Changing your coverage. Additional clauses and endorsements are additional benefits of the policy that you can add to a policy to expand coverage, usually for an additional premium. Some of the most common endorsements are: life insurance adds additional term life coverage to a policy of regular or universal life. For example, if you need $500,000 total coverage, you could purchase a permanent life insurance policy of $100,000 with an additional clause additional term insurance of $400,000. As you have more income, you can convert part or all clause to the universal life policy. The guaranteed insurance ensures you can buy additional to the company's future coverage, regardless of their age or health condition. These factors could be used anyway to determine the amount of your insurance premium. You should purchase additional coverage by a particular date or event set life, such as retirement or reaching 65 years of age. Accidental death provides a death benefit if you die as a result of an accident. In some cases, a provision of accidental death in your policy may pay twice if you die because of an accident. Certain restrictions may apply. Exemption from payment of premium disability insurance covers your insurance premium if you qualify as physically challenged as defined by the policy. This benefit continues for the duration of the disability. This additional clause is usually only available to persons under 60 years of age. The accelerated death benefit, because it is an option for partial or total prepayment of death benefits while you still live if you are diagnosed with a terminal illness, specific disease or long-term care. Often, people buy this clause to help pay for the care you need at the end of your life. The additional clause usually requires a doctor confirms that you cannot perform certain activities of daily living. Spousal clause amendment provides additional term coverage for your spouse. Essentially, this additional clause combines two policies in one. The amendment to clause provides coverage for children term for their children. Most companies require that the child is at least 14 days old, and usually the coverage lasts until the child turns 21 or 25 years of age. Payment options. Companies typically pay the death benefit in one lump sum. However, there are other payment options. You or the recipient can choose how the death benefit will be paid. Common payment options include the option of interest. The amount of the death benefit remains with the insurance company, and the company regularly pays interest to the beneficiary. Fixed period. The company pays the death benefit at regular intervals with interest over a selected period. Reimbursement of life. The insurance company pays the beneficiary a monthly amount set for the rest of your life. With this option, the beneficiary may receive more than the specified death benefit if he or she lives longer than expected. Know your rights. Timely payment of death benefits. Insurance companies should pay the beneficiary the amount of the life insurance policy within 2 months from the date the proof of death is received and have verified the beneficiary. For an individual life insurance policy, the company must also pay interest on the death benefit from the time the company receives the proof of loss statement until the company pays the death benefit. If a payment of your insurance premium missing. Most policies have a grace period of 31 days after the date of payment of the premium, which you can afford without being charged interest and still be covered. If you die during this period, your beneficiary receives the death benefit minus the premium due. If your policy has expired, the company may require you to pay part or all of expired insurance premium to restore a policy that has expired with interest. If the expiration of your policy, you have a loan on your cash value, the company may also require you to pay the unpaid interest and reinstate the loan. Most companies will restore a policy within a period of 5 years, but may be required to answer some questions, additional health or other medical examination. Buying life insurance. When you apply a policy to buy life insurance, the company will assess your risk factors. According to the information you provide, the company will decide whether to sell a policy and how much it will charge. In this evaluation, it is called underwriting. You can expect to fill out a health questionnaire. You may also need to provide medical records, undergo a medical examination, or complete financial questionnaires. Trial period. It is important that you fill out the application completely and accurately. The life insurance policies have a trial period of 2 years. If you die during this period, the company can investigate the cause of death and verify the information you provided in the application. If the company discovers that you provided incorrect information or withheld information, you may deny payment of the death benefit. It may be the case even if the information is not related to the actual cause of death. If the company denies payment, you must repay the premiums you paid into the policy. Once your policy has been in force for over 2 years, it is indisputable unless you do not pay your premiums. If you die for any reason after this period, the company must pay the death benefit. Never allow another person, including a broker, sign your application on your behalf. Most companies will not pay the death benefit during the first 2 years of the policy if the cause of death is suicide. If the company does not pay the death benefit in case of suicide, it will return a number of insurance premiums paid. Choosing the right amount. There is no formula to determine the amount of life insurance you need. Some consumer groups recommend buying an amount of coverage that is 5 times your annual household income, while others recommend 10 times your income. To decide the amount that is right for you, consider how much debt you have, the amount of income you will need to replace your family, and if your survivors will have other expenses to pay, such as college costs or funeral expenses. Also consider whether you want to leave a bequest or gift to your beneficiaries. It is also important to consider the value of the services provided by people who do not generate income. For example, should include care and household management of a parent who stays at home with the children. Smart buying life insurance. Get quotes from several companies. Each insurance company uses its underwriting guidelines. A company can sell you a policy with an insurance premium substantially lower than another company. Two types of life insurance agents have income from wages, commissions, bonuses, or a combination of the three. Captive agents only sell policies from the insurance company for which they work. Or independent or brokers, agents sell policies from several companies. A broker can provide several quotes from different companies during a single visit or phone call. Make your comparisons. Make sure you compare policies offering similar coverage levels. The more features, options, and benefits include a policy, the more it will cost. A cheaper policy may have few features or provide a substantially lower death benefit. A more expensive policy may have a better value when taking into account the amount of the death benefit for every dollar charged. Do not choose a policy based solely on price. Agents often use tables to show how you can grow the cash value of policy. Confirm that the table shows a cash value that is guaranteed by the insurance company and not a financial projection of what the company currently pays. The projections are based on assumptions and should never be relied upon as a promise of performance of the policy. You may earn much less than the projection. Ask your agent a history of company projections versus the current growth of cash values. The agent should not oppose this. Be careful if an agent tells you that the interest or dividends earned on your policy will make your insurance premiums disappear during the life of the policy. If interest rates or dividends decrease, you may have to pay higher insurance premiums or pay more for a longer period than you expected. Some agents also sell retirement investments and student loans. The law prohibits operators offering discounts on investment or loan or offer any gift to induce them to buy life insurance. If you think that an agent has made an improper offer, call the consumer helpline. Insurance companies sometimes marketed the life insurance policies as tools for saving for retirement, succession planning, elective funds, or mortgage protection. Failure to clearly identify a policy as life insurance is a false statement and violates the law. If you think that an agent or company has made a false statement in policy, call the consumer helpline. Several simple guidelines can help you avoid becoming a victim of insurance fraud. A policy or never pay with cash. Or never sign a blank application form. Consider the company before buying insurance by phone or on the first visit. If you need help choosing a policy, ask a friend or family member to visit the agent with you. The agent should not oppose this. Financial implications of having a life insurance Medicaid. The cash value of life insurance policy is considered as an asset when determining if you qualify for Medicaid. Part or all of the proceeds from a loan obtained using the policy as collateral may not be considered as an asset under certain circumstances. If you have Medicaid, you should talk with a lawyer or financial advisor to understand any consequence of having a life insurance policy. Taxes. The cash value of life insurance policy usually accumulates tax deferred. It means that you do not pay taxes until later. Withdrawals of cash value are not taxed until withdrawal amount exceeds the total insurance premiums paid into the policy. The law considers the death benefit as reimbursable loss payee and not income. Therefore, the beneficiaries do not have to pay federal income taxes or inheritance taxes for the payment of life insurance. If a policy has not named a beneficiary or the beneficiary dies, the death benefit is paid to the estate of the insured. The heirs will then have to pay taxes on the money received. If you are considering purchasing life insurance, talk to a lawyer or financial advisor to fully understand the tax consequences. See examples of situations where life insurance resources may be useful. Payment of final expenses. The costs of a funeral and burial are usually very high. Make a life insurance to save your wife or husband, children or parents of suffering financially in a moment they will be emotionally shaken. Investment for the future of children. Like most parents, you probably want to make sure that your children will be well looked after and may have a quality education even in your absence. Replacing the income of the spouse. Nowadays it is common that tasks and family expenses are divided between the couple, and the impact significant in the standard of living is one of the two missing. Hire someone to help with household chores or caring for children may be necessary and costly. Payment of debts. Also, to cover daily expenses, your family needs the life insurance amount to cover debts, such as loans, financing and the provision of home or car, for example. Buys shares of a business partner. If you have your own business in society, you need life insurance, and your partner too. If one of them dies, the other part of the partnership will have to bear the obligation of the company not to run the risk of having to sell it. Although banned, many people hire life insurance and pension plans in the United States. In the USA, a law that makes life insurance that is entirely tax-free was created. This type of life insurance law offers all the people an easier way to acquire wealth. There then enters the part of the life insurance service in the United States is the same as an investment that you are making and that after some time get all the amount you invested. However, life insurance does not serve only for investment, and Americans are very concerned about their health and their lives, then the demand for life insurance is too high. However, for many Americans, what matters is to use it safely with one investment. So you purchase a life insurance policy of $1 million, and throughout your life you pay $250,000 for your insurance. All your heirs will receive $1 million and also will have no tax. Thus, we can conclude that you will make a profit of $750,000. For this and many life insurance services in the United States is that this product is highly sought after, and also by hiring this service, you are ensuring your whole family a great legacy for years to come. To make a life insurance isn't usually part of the financial planning of the Brazilian, remaining an unknown land for most people. Much of adults able to make a fact of life insurance have a policy, and most of those insured are not covered according to their actual need, but according to the offer received, especially when insurance is offered by the company where they work. To choose the insured amount, you need to consider a number of factors, but many people choose blindly from a table without considering the real needs of your family. To choose the correct value, you need to consider 3 factors: your household budget, expenditure on education of your children, and the existence of inventory, especially in the case of accidental death, when there has not been performing any succession planning. Chapter 3. Day by Day and Education of Children. So we need to put the tip of the pencil as your family spends to survive each year, and their children and your children will still need to complete the studies, how much and how long its financing consume resources, and how much would be required for emergency expenses soon after the death of the holder. Also, consider that the monthly income you want your family to receive and for how long. If you have small children, think that, for each one, you should have considerable expenses only education, lifelong. Although the insurance offered by companies to their employees provide horizons 24 to 36 months of income for beneficiaries, you may prefer a longer period. It may not be enough for your family to be restored. A horizon of 5 years may be more appropriate. It tends to vary from case to case. That is, if your children are little, more coverage may be required than if they are already completing their studies. If your goods have already been settled, or if you have more than one property to take care of, the insured value may be lower. You may contribute to the support of your parents or your parents-in-law. In this case, take this into account when calculating your family budget. Inventory leaves and available goods. The issue of inventory should not be ignored. In the case of accidental death, especially in youth, is a succession planning involving the donation of their goods is likely that Insured has not yet started. The opening inventory will be inevitable and costly for their heirs can be quite time-consuming. As insurance products do not come into inventory, freeing resources directly to the account of the beneficiaries, the insurance helps ensure the survival of the family while other goods are not released. Review the coverage periodically. As the cost of insurance grows throughout life, since the probability of death also increases, insured's needs also change. Depending on the stage of life, the standard of living and the financial needs of families vary widely. A young couple with small children still have many expenses with young children and to build equity, but the standard of living is lower. An older couple probably will have fewer expenses with kids and other dependents, but the level of life of all certainly will be higher. Therefore, the recommended review your needs and the amount insured to renew your policy, which can be done annually or at longer periods. Life insurance is not recommended for older people, but for the younger ones who have not yet accumulated enough. Like any other type of insurance, life insurance covers a risk. While auto insurance covers the risk of you having the car stolen or beaten, life insurance covers risk if you die and leave someone behind helpless financially. That's exactly why, contrary to what many people think, life insurance is not necessarily recommended for seniors, but for the younger who have not accumulated enough. When we talk about younger people, we are referring only to those who have dependents. So if you are 20-something and are not married or have children, insurance may not be the best option. In this case, it is best to save. Invest your money to increase your wealth. On the other hand, if you are already married and have children, the situation changes. If something happens to you, your family can come to be in need. In this sense, the decision to buy a life insurance should be taken based on your financial situation. If you have accumulated enough in case of fatality, it is possible to maintain the standard of living of your family, either through the sale of its assets or income received with your applications, and then the life insurance is not so necessary. Chapter 4. Pension or Insurance. Some people get confused when choosing between a life insurance or a private pension plan. The two products are very different and should be seen as complementary and not as mutually exclusive. The pension plan should be considered as long-term savings, that is, part of your investment strategy. But the life insurance is not an investment, but a hedge. The funds accumulated in the pension plan should be seen as the stock you need to accumulate to retire. Thus, the closer to retiring, the greater the stock and less need for insurance. On the other hand, for younger, this stock may not be enough to support the family in case of death or disability, so that insurance is an indispensable complement. If you have not accumulated enough, the best option is to combine life insurance with pension plans. Another frequent question is whether more worth is making a life insurance or an accident. First of all, one must understand the difference between them. Life insurance covers risk of accidental or natural death and disability due to accident or illness. As for the accident insurance, covering the risk of death or disability caused by accident. Many people end up opting for accident insurance, which is cheaper, but also has a more restricted coverage and its price does not change according to age, unlike life insurance, which increases with time. According to some industry experts, for young people, the cost of the two products is virtually the same as it is based on the risk of the insured come to die. As the risk of death is low, the major component refers to the accident. In this sense, accident insurance is more recommended for young people without dependents. On the other hand, the value of life insurance should decrease as a person ages, because, in general, their economies grow, reducing the risk that your family will need in case of death.